Before you invest a single dollar, there are a few things that you really need to understand first. Because investing is one of those areas where doing things out of order doesn't just slow you down, it can actively set you back and create stress and costly mistakes that most people don't even realize until it's too late. Compare these steps that I'm talking about to building a house. If you don't build a strong foundation, the whole house is going to collapse and not be steady. The house won't weather the first storm. If you skip these steps, you're basically building your financial future on a cracked foundation and hoping something doesn't expose it later down the road. So in this video, I want to walk you through the things that you should have in place before you invest, and I'm going to give you a practical framework that helps you sleep at night and stay invested long enough to win. The very first thing you need before you invest is to build a strong emergency fund. You need to have cash on hand because life will always throw you a curveball when you least expect it. I'll give you a personal example of this when I was in college. A lot of people can relate to this because car problems always suck. But I had a job when I was in college and I used that money to pay for living expenses and my discretionary spending. I wasn't really big into investing yet either in college, so I didn't really have an emergency fund saved up as well. I would get paid and then kind of just deposit that money into one bank account, and that was used for everything. So then one day I had a super expensive car maintenance coming up where I had to change brakes and do all other sort of stuff on my car to repair it. And I didn't really have the money properly saved up for that because I didn't have dedicated emergency fund. And I had to pick up 3 extra shifts at work to be able to pay that credit card bill off. This obviously wasn't the end of the world. And this is just a daily example that could happen to anybody. But this just goes to show that if I had properly budgeted for an emergency fund or some big expense like this, that I would have been far more prepared and my time would have been freed up. I could have used those extra shifts at work and used that money for other stuff. So long story short here, if you don't have cash set aside for emergencies or big payments coming up, your investments or your discretionary spending could eventually become your emergency fund. And that almost always happens at the worst possible time. The reason I say build up an emergency fund first is because you don't want to have to sell off portions of your investments to cover an unexpected bill. And when something goes wrong, if your only option is to sell investments to cover for it, you're forced to sell when you don't want to, which completely defeats the purpose of long-term investing. You're also going to have to pay those investment taxes when you sell, and sometimes, depending on the situation, that could fall under short-term capital gains taxes, which are much higher than holding long-term investments. Your emergency fund should be in a high-yield savings account, getting you better interest than your traditional checking or savings account. So most high-yield savings accounts can yield anywhere from about like 3 to 4%, and sometimes even higher depending on the economic conditions. An emergency fund isn't about returns, it's about stability, and stability is what allows you to stay invested through the hurdles that life gives you without panicking or making emotional decisions. For most people, this means about 3 to 6 months of essential living expenses in a high yield savings account, not invested, not locked up, so that when life happens, you don't have to touch your investments at all. The next thing you need to get under control before investing is your high interest debt, especially credit cards or personal loans, because mathematically and psychologically, this is one of the biggest drags on your financial progress. If you're paying like 18, 20, or even 25% interest on a credit card debt, and you're paying over 7%, and if you're paying over 7%, let's say on student loan debt, and I'm going to use 7% here in this video, but you may feel different about that number, and I'm going to get into it. But the most basic investment strategy is the S&P 500, which after taxes and inflation could account for about 7% per year for capital appreciation. So the numbers on paper lead you to paying off any high interest debt above 7% before investing, let's say in the example of the S&P 500. Every dollar you put into investments while carrying high interest debt is essentially fighting an uphill battle, because on one hand you're trying to grow wealth, and on the other hand you're actively losing money because that high interest debt is outworking your investment gains. And talking about other factors beyond just the mathematical numbers, debt creates mental pressure because it forces you to think in the short term, and it increases your stress in the present day. I personally don't like carrying debt, and I don't know anybody that does, and it's something that everyone needs a plan of attack to get paid off. Now, this doesn't mean you have to be completely debt-free before investing at all, but it does mean that you should aggressively eliminate high-interest debt so that your money can finally start working for you instead of against you. The third thing before you invest, you need to be very clear on when you'll need to live off of the money and when you want to use your invested money. because investing without a time horizon is one of the fastest ways to end up losing in your investment journey. Let me explain here. Money you need in the short term, meaning anytime in the next, say, 2 to 3 years, should not be invested aggressively because markets move in cycles up and down, certainly not in a straight linear line. And short term volatility can wipe out years of gains right when you need to access the investments. And when I say aggressively, that can include most ETFs and mutual funds because they are tied to overall market performance. And a global pandemic or a housing crisis can make those funds come crashing right down before you need to start pulling that money out. That's why you've probably heard of a target date funds where your allocations slowly start to get less aggressive as you approach retirement or when you need to live off that money. On the other hand, money that you don't need for 10, 20, 30 years can handle volatility because time is what smooths out the risk and allows compounding interest to actually work. The mistake I see most people make when investing is that people think that they might need their invested money soon, and then start panicking when they see the market drops, even though nothing fundamentally changed from what they're invested in. You just have to stay disciplined and formulate a plan for yourself and stick to it, because once you bring emotions into investing, it can make reaching your goals more difficult. So before you invest, ask yourself one simple question. When will I need this money? Because your answer depends on not just what you're invested in, but whether investing is even the right move at all, and what accounts you decide to invest in. Your time horizon for investing will determine if you should invest in a Roth IRA, a 401k, a traditional brokerage account, etc. If you are young and want to invest in retirement, consider utilizing the tax advantage accounts such as a Roth IRA, a 401k, an HSA. And if you're trying to invest for an early retirement, then consider using a traditional brokerage account because it has the most flexibility. It's okay if it takes a little bit of time in your early 20s to define your time horizon, but it's important that you start having these honest conversations with yourself to help put you in the right direction when you are investing. The fourth thing that you should do before you invest, and this one sounds obvious, is to understand what you are investing in. You'd be surprised at how many people get this one wrong. You don't need to understand every technical detail, but you should understand the basics behind an ETF or an individual stock that you're investing in. A really simple way to think about this is to compare an ETF like SCHD to an individual stock like Meta, because they represent two very different types of risk, return, and expectations. Let's start with SCHD. When you buy SCHD, you're not buying a single company, you're buying a diversified basket of large, established U.S. companies that have a long history of paying consistent dividends, growing their cash flow, and generating real profits. This ETF holds companies like Pepsi, Coca-Cola, Verizon, and other boring, stable businesses that generate cash year after year. SCHD is designed to prioritize income and stability over growth, which means you're not buying it because you think of capital appreciation is going to double overnight. You're buying it because you want steady dividend income, lower volatility, and long-term compounding growth through dividend reinvestments. The upside to something like SCHD is that no single company can completely blow up your portfolio because risk is spread across dozens of companies, and even if one company underperforms the market, the overall fund should still do fine. The trade-off is that SCHD will likely never deliver the kind of massive upside that you might see from a single breakout stock, let's say Nvidia for example, because diversification smooths out both gains and losses. Plus, you don't have tech companies in SCHD because it's focused on blue chip companies that are not reinvesting as much into their business and instead paying out their shareholders in the form of a dividend. Now compare that to buying an individual stock like Meta. When you buy Meta, you're making a very specific bet on one company, one leadership team, and one business model. You're betting that Meta can continue to grow advertising revenue, monetizes platforms like Facebook and Instagram, the platforms you use every day, and successfully invest in long-term initiatives like AI and virtual reality without getting outpassed by other tech companies. The upside is going to be obvious here. If Meta executes well, their returns can significantly outperform the broader market or a dividend ETF like SCHD, because all of your capital is concentrated in just that one company. But the risk is just as real, because if Meta makes poor strategic decisions, they could face, say, regulatory pressure. They could fail on a couple of big projects. Then your investment feels it immediately and directly. There's no diversification, and there's no safety net like there is with an ETF when you choose individual stocks. And this is where understanding what you invest in and own becomes critical. Owning SCHD requires patience and trust in boring consistency because it's not meant to excite you. It's meant to quietly work in the background and compound over a long period of time. Owning Meta requires conviction in the business model and emotional control because the stock can swing rapidly, headlines can turn negative overnight, and you need to believe in their long-term business. Neither approach is inherently better, but they're just very different, and problems happen when people treat them the same. If you buy SCHD expecting rapid growth, you'll be bored and then you're going to abandon that strategy. If you buy Meta without understanding the business, you might panic sell the first time it drops 30% in a year. So before you invest, you should be able to answer one simple question for every holding in your portfolio. Why do I own this, and what role does it play in my long-term plan? The fifth thing to understand before you invest is understanding the investment accounts that you are using. This matters more than people realize. There is a massive difference between investing in a taxable brokerage account, a Roth IRA, a traditional 401k, or an HSA, and those differences impact taxes, withdrawal rules, and long-term flexibility. You can have great investments in the wrong account and still lose a lot of money due to taxes or penalties simply because you don't understand the rules going into that specific account. So before you invest, you should know whether your account is tax advantaged, when you can access the money, and what happens if you withdraw early, because optimizing where you invest can be just as powerful as what you invest in. I'll explain some of the more popular accounts. Let's start with the Roth IRA. A Roth IRA is one of the most powerful investing tools available, especially if you're earlier in your career or young, because you contribute money that has already been taxed, and in exchange, your investments grow tax-free and compound tax-free and can be withdrawn tax-free in retirement. Another big advantage of the Roth IRA is its flexibility. You can withdraw your contributions at any time without penalties or taxes, which gives it a unique combination of long-term growth and early retirement access. The downside is that there are contribution limits and income limits, so you just can't dump unlimited money into it, which is why most people use a Roth IRA as a foundational account rather than their only account. If you are a high income earner, you can always do a backdoor Roth IRA, and the steps to make that happen are pretty easy. Most brokerage platforms will walk you through how to do that. Now let's talk about 401ks. A traditional or pre-tax 401k allows you to contribute money before taxes, which lowers your taxable income today. Then you pay taxes later when you withdraw the money in retirement. This can be incredibly useful if you're currently in a higher tax bracket and expect to be in a lower one later, because you're essentially deferring taxes to a future version of yourself. A Roth 401k, on the other hand, works more like a Roth IRA. You pay taxes on the money now, but your investments grow tax-free, and qualified withdrawals in retirement are not taxed. The decision between Roth and pre-tax often comes down to your current income, your future earning potential, and your expectations around tax rates. But the key takeaway is that both are powerful, and the real mistake is not using any of them at all, especially if your employer offers a match. The employer match is free money, and skipping the employer match could result in a lot of lost potential with compounding interest. Next is the HSA, or Health Savings Account, which is easily one of the most underrated investment accounts out there. If you're eligible, an HSA offers what's often called a triple tax advantage. Your contributions are tax deductible, your money grows tax-free, and withdrawals are tax-free if used for qualified medical expenses. And here's the part most people don't realize. You don't have to use the HSA right away. You can invest the money, let it grow for decades, pay medical expenses out of pocket, and then reimburse yourself later in retirement, effectively turning an HSA into another sneaky good retirement account. The catch is HSAs are only available if you have a high deductible health plan, and there are contribution limits, but for people who qualify, it can be the most tax efficient account out there. And finally, there's the taxable brokerage account. This is the most flexible account because there are no contribution limits, no income restrictions, and no rules about when you can access the money. You can invest as much as you want and withdraw at any time. The downside is obviously taxes. You'll owe taxes on dividends, interest, capital gains, which means a portion of your returns always get skimmed off along the way. That doesn't make taxable accounts bad. It just means they're probably best used after you've taken advantage of the tax advantage accounts. Or at least that's my philosophy. But most people prioritize a taxable brokerage if they need flexibility or their goals aren't strictly retirement focused. So when you put all this together, it's to understand the role that each account plays for your investment strategy. The Roth accounts give you tax-free growth. The pre-tax accounts give you tax deferral. HSAs give you the best of all worlds with a triple tax efficiency. And taxable accounts give you the most flexibility. And last but not least, before you invest, you need to make one decision that matters more than all the other ones I've talked in this video combined, and that is committing to being a long-term investor. Because the market rewards long-term investors, and the biggest gains always come from staying invested. Long-term investing means accepting that compounding interest and progress happens slowly, quietly, and often invisible for the first few years of investing. It means trusting the process when it feels boring and resisting the urge to react emotionally to headlines. And the people who win over decades aren't the ones who time the market perfectly every time. They're the ones who stayed consistent, disciplined, and invested long enough for compounding to do the heavy lifting. If this video helped clarify things for you, hit that like button, subscribe for more straightforward investing and personal finance content, and let me know in the comments what part of investing you're still unsure about, because that's exactly what this channel is here to break down for you. Let me know what your favorite accounts to invest in are and how much you have invested in each account and what are your goals for 2026. I'll see y'all in the next one.